Ladies and gentlemen, welcome to today's fiscal sermon in the Church of Common Sense. Presided over by yours truly, Brian Rue, your humble shepherd through the treacherous pastures of financial planning. Now, whether you're the kind of person who stuffed their 401k until it's bursting at the seams with a cool million, or you're starting out with a more modest but equally hard-earned 100,000, you're probably aware that shoveling your greenbacks into 401k or a similar employer-backed money pit is as close to a silver bullet for a cushy retirement as garlic is to repelling vampires. However, lurking in the shadows, there's a gremlin called taxation waiting to snatch a chunk of your retirement nest egg. Indeed, the traditional 401k can seem like a cozy tax-deferred blanket until you realize that one day you'll have to wake up, roll out of bed, and pay the piper. And if you're raking in the dough, you might just find yourself paying Uncle Sam an even higher rate than at today's current tax brackets. Enter the Roth 401k, the financial world's equivalent of a garlic necklace keeping the tax vampire away. Much like Roth IRAs, stuffing your dollars into a Roth 401k is a post-tax affair. But the magic trick here is that any withdrawal you yank out after the age of 59 and a half, having clung on to that Roth account for at least 5 years, are yours, free and clear. The tax man cometh not from thee. Now, if you're sitting pretty at the top of the earnings tree, you might have hit the income ceiling with the regular Roth IRA. But here's the punchline. With a Roth 401k, there's no income limits. The sky's the limit. Here's the kicker, though. More than 3/4 of employer plans are now dangling the Roth 401k carrot, but only about 17% of employees are biting. And this, by 2026, Secure Act 2.0 is nudging workers who are 50 and older and earning north of $145,000 to make catch-up contributions to Roth 401ks. The IRS, in their infinite mercy, postponed this until 2026. And that's why plan providers have little time to implement all the changes our friends in Washington have passed on. So why the Roth route? Well, if you're the kind that stockpiles gold coins in your tax-deferred Scrooge McDuck vault, aka Roth 401k, you'll miss the upfront tax break from a traditional 401k. But remember, the tax deduction isn't a gift, it's a loan. They want their money back with interest, aka higher potential taxes. Also consider this. Since the new RMD age for many pre-retirees is now 73, and for some it'll be 75, since there's less years to spread out the required distributions, you could end up coughing up more in required minimum distributions than you earned in your last years of working. And this isn't just a tax issue. Oh no. We're talking potential meddling with your Social Security tax and even triggering surcharges on your Medicare Part B and D. It's like inviting the tax man to your retirement party and finding out he's a very hungry guest. But hold on, higher earners. You guys aren't the only folks who should eye the Roth 401k. If your earnings are more modest, the allure is even stronger. Why? Because for you, the tax deduction of a traditional 401k is as valuable as a chocolate teapot. Plus, the longer your money has to grow, the more tax-free muscle it will flex in the retirement ring. Now let's not dawdle on hypotheticals. Instead, let's take a look at a few action steps. Action item 1. Sit down with a calculator and your last tax return. Crunch those numbers or get a number cruncher to do it for you. Figure out if the tax deduction now is worth more than the tax you'll pay later. Action item number 2. If you're staring down the barrel of a hefty required minimum distribution, consider the Roth 401k your financial bulletproof vest. Do the math on those future distributions and see if they might eat into your other benefits. Action 3. For the young or the modest earners, don't walk past a Roth 401k without giving it the googly eyes. Compounded tax-free growth over decades? Yes, please. Action item 4. Check if your employer's plan has a Roth option. If they do, and you're not in it, it might be time to jump in. If they don't, agitate for it. The cost for a simple plan change is nominal, and it benefits everyone should they have access to it. Action item number 5. Finally, consult with a financial planner who understands the twists and turns of the Roth 401k. You wouldn't climb Mount Everest without a Sherpa. Don't navigate retirement planning without a guide. In closing, remember the Roth 401k isn't just a shiny new toy for the financial elite. It's a workhorse in the stable of retirement planning. Don't let the taxman put a damper on your golden years. After all, retirement should be about sipping pina coladas on the beach, not about writing checks to the IRS. So let's meet, talk it out, and make sure your retirement plan is more secure than Fort Knox. Stay vigilant, stay saving, and as always, keep doing life better. Please like and subscribe before you go, and we'll see you next time.